Out with the old and in with the new. The Bank of England has given the markets what we were expecting, a cut in the base rate to 4.25%. But, Peter, there was a sting in the tail.
There was, Jack. It wasn't unanimous.
Yes, we will be unpacking what that means for the mortgage market and where we go now in terms of rate cuts. I'm Jack Izzard.
And I'm Peter Stimson.
This is The Rate Stuff. The Bank of England's Monetary Policy Committee surprised no one with its decision at its meeting at the start of May. The base rate has been cut to 4.25%. But it wasn't the slam dunk we were all expecting. Peter, there was a little bit of a surprise there in the decision itself.
It was. I mean, the vote was 5-2, which isn't a sort of a football formation with someone sent off. So we had two people actually voting for a 0.5% cut, which, you know, you can perhaps understand. But we also had two people voting for no change. So the impact on that is we've actually seen swaps tick up slightly in the sort of intervening sort of immediate period afterwards. So what does that mean? Well, it still means we think we've got another couple of rate cuts coming this year, but probably not as quickly as, you know, we perhaps first anticipated. So rather than a rate cut perhaps coming in June, it's probably looking more like August, and then probably one in the last quarter in maybe November.
Okay, so no change in the direction of travel. It's just a kind of a dab on the brakes, if you like, that timing question.
Yeah, it's just a little bit slower. That's kind of what the market's thinking. So, you know, the market maybe anticipated cuts a little bit quicker. It's probably still happening, but, you know, just slowed down a little bit.
Okay, so the swap market has already reacted, and of course it's the swap market that determines the rates that lenders offer.
Yes.
Let's just kind of work this through together. So next couple of weeks, we're probably not going to see any big rate cuts from lenders now because those swaps are reacting already.
Yes, I mean, lenders are sort of catching up to where the swaps had got to. So swaps have been dropping since, obviously, Liberation Day. You can see from the swap graph that's gone up, you know, where swaps have gone since the beginning of April. So no real change, we don't think, on mortgage pricing. You know, swaps continue to react and move slightly upwards. You might get some slight adjustments upwards. So we think, you know, mortgage rates have probably got as low as they're going to for a little while. So yeah, just really steady as she goes.
You say that, and yet that swap curve just a week or so ago was looking really quite sharply down. Do you think that the mortgage market got a bit ahead of itself?
Possibly. I mean, it's really kind of looking ahead. So, I mean, obviously the 2-year and the 5-year swap rates are looking ahead over that period. So it's kind of the average rate over that term. So it is forward looking. So, you know, it's anticipating what rate cuts are going to happen. Sometimes it gets it wrong. Sometimes it gets it right. Sometimes it's, you know, anticipating cuts which don't happen. So yeah, it maybe got slightly carried away.
Okay, so let's work through the numbers together. We're at 4.25% now, and assuming we get 2 more cuts during the course of this year, albeit not as quickly as previously thought, so maybe not June for the next one, a little bit later than that, that would still put us comfortably below 4% by Christmas, right?
It would. Where we go from there is obviously very challenging to sort of try and predict at the moment. We've obviously got inflation still pushing through the economy. We've obviously got growth, which is challenging. We've obviously got free trade agreements being signed at the moment. We've had 2 in the last week. So predicting where we go after Christmas is very difficult at this stage. So I wouldn't really like to try and put too much on that, to be honest.
Well, Peter, I'm afraid that's where we're going to differ, because I want to put you on the spot here,
right,
and I want you to accept that challenge, because
okay,
we've been talking for a while, haven't we, about rates are going down, how low do we want them to go?
Yep.
And that is the topic for today. Stay with us. We've all been to a party where the drinks have been flowing and the comedy games come out. Could be Twister, could be limbo dancing. The thing about limbo dancing is the lower the better. The lower you can go, the better. And it's tempting to think that it's the same with mortgages. And speaking as someone who's due to remortgage soon, I'm quite keen for rates to keep going lower and lower. But Peter, it isn't necessarily good economic sense or even mortgage sense for rates to go down and down and down. And so our big topic today is, how low do we want them to go?
It is. One thing we've sort of talked about, and we touched upon it in the last episode, is the impact on affordability and the changing affordability and the impact that has on the housing market. We're just putting something up on screen now which kind of illustrates the change on the stress rate over the last sort of couple of years. The stress rates lenders were using sort of go back to August 2023 was round about sort of 11.5, 11 and 3/4. And it's dropped, and it will be dropping with the sort of change in bank base today to around about 7%. Now the stress rate's kind of made up really of three things. It's made up of the bank base rate, which has obviously dropped from sort of the peak in August 23 from 5.25 down to sort of 4.25 now. So that's dropped by just around 1%. The imposed stress rate coming sort of from the FCA, which was around about 3% then, because obviously interest rates were very high, down to sort of around 1% now. And obviously the lenders' own standard variable rate. Now lenders in the period sort of from sort of around about sort of 2 years ago to now, most of them have actually cut their SVRs. So you've had sort of three sort of cuts in that regard. Now what that actually effectively means is, in theory, or when you actually look at it, someone can borrow around about 160, 170% more. So that's kind of a huge increase if you're looking at that, despite the fact that bank base has only dropped by around 1%. So, when you look at it like that, that's kind of a huge challenge to sort of a housing market. Now, the only reason why that really doesn't often work in practice is because of the LTI limit. The limit that, lenders have to or can only actually lend 15% of their book above 4.5 times a customer's income. So, that's a real kind of challenge in terms of, managing house prices and trying to keep the market in some sort of order.
Yeah.
And again, if you're looking at kind of another two cuts to bank base this year, that's looking at another sort of 10 to 15% increase in affordability for a customer, which is great if you're a mortgage broker out there. But again, you have to look at the implications to a housing market where there's already a shortage of supply. And what does that really mean for a stable, affordable housing market, and trying to make sure things are rational in the long term?
I mean, it's almost like there's a tension between the two, isn't it? Because from a mortgage broker's point of view and a borrower's point of view, well, the cost of finance is lower and they can borrow more. Happy days, right? But you're saying that potentially poses all kinds of problems for the market as a whole, because it's going to just light a fuse under price of houses.
Potentially it does. I mean, the FCA are consulting on it at the moment. Anybody's interested, it's MCOB 11.6.18R is what the FCA used to obviously ask lenders to assess affordability, and they're consulting on that at the moment. So, the FCA are aware of this, and obviously the PRA are aware of this, so they're kind of looking at the rules at the moment. So, affordability is a big challenge, particularly for first-time buyers. I mean, in London, for example, 30% of borrowers have to exceed the 4.5 times income rule to actually buy a house. So, it is obviously a big challenge. And it's not going away anytime soon. So, even as the affordability has increased with the stress rate going down, you're getting capped out on the LTI rule. So, it is a big challenge, but, there needs to be a balance between, lowering interest rates and, keeping the housing market in some sort of, balance in that regard.
Well, we have got a long and sorry history of boom and bust.
We have.
With property markets, and we're at that kind of inflection point now, aren't we, where house prices are relatively stable, but with mortgage rates coming down and down and down, they could start rocketing back up again.
There is that potential, but it's, finding a sensible balance, basically.
Okay, we've been talking about doing this for ages. It's time to put Peter on the spot and get him to choose the perfect base rate. Now, Peter, in scenes reminiscent of the meeting room for the Bank of England's Monetary Policy Committee, I want you to choose, completely at random, your ideal base rate.
Okay.
Pick a card, any card. Any card, Peter.
That's a surprise. I've chosen 3.5%.
By absolute coincidence,
pure
3.5%.
coincidence.
So, okay, Peter, why is that the perfect base rate for you?
Well, I think it's coming back to the theme of the Goldilocks rate. It's not too hot, not too cold. I think it really kind of suits the savers. So, in all of this equation, we seem to forget sometimes about the savers out there. When interest rates are really low, savers got absolutely crushed out there. So it still gives them some interest and gives them some return. I think the rate of interest is low enough that it gives mortgage borrowers, low enough payments that it kind of allows them to borrow decent enough amounts of money at an affordable rate. And importantly, I think it allows the housing market to grow at a long-term sustainable rate and gives enough house price inflation in there to keep the market sustainable long-term.
Yeah. No, good points, well made. Speaking as someone who's due to remortgage quite soon, I would like to suggest a number. Just a power of suggestion.
Guessing what this comes out at.
How does that look, Peter?
Yes, it's not really surprising 0.5%, but it looks interesting. And if I was an individual, I might well be voting for 0.5% myself. I think the challenge with that is long term, it's not very healthy for a housing market. We kind of had rates around about that level for kind of 10 years, and it created an asset bubble in the housing market. You get, long term, you get growth in a market for the wrong reasons. It's not really sustainable. It's not really healthy for the general economy. It doesn't really give the bank anywhere to go long term about stimulating markets when you've got rates that low. Yeah. And it's just really not healthy for a long-term functioning, sustainable housing market.
Yes, no, it's sort of intoxicating, but we need to wean ourselves off that.
We do. I mean, low interest rates are a kind of a drug we need to get away from.
Yes, so some cold turkey from me and probably a few other mortgage borrowers out there. We need to remember, of course, there is much more to the Bank of England base rate than just mortgage interest rates. There's also the impact on savers and the broader economy as a whole. But of course, here on the Rate Stuff, we like to track every twist and turn of the mortgage rate market. One thing, Peter, actually, I've just realised, we've been through the whole episode without mentioning the orange guy in the White House.
I know, it's amazing.
Long may that continue. And of course, if you've enjoyed the show, do give us a like or a follow on the socials and join us next time. I've been Jack Izzard.
And I've been Peter Stimson.
And this is the Rate Stuff.